Hey everyone, Ryan Bolton here. I am a mortgage nerd. Welcome to the Mortgage Market Report. We always like to start out with the MBS, the mortgage-backed security market. At the time of this recording, about finished with the day's market here, we're about 21 basis points better. That's a really big turn and shift from last week. Last week, we lost more ground than we gained. Just a lot of economic news that came out, kind of a short week with the holiday as well, a little less time to digest everything that was happening. One of the big reasons I think for that too is just some weak data on the bond market. It wasn't as strong of a sell. They had the 2, the 5, and the 7-year note auctions, which was at I think 183 billion, but the results were pretty poor. The demand for higher rates in the bond market kind of drove that demand down a little bit. So they did want to see some higher rates available on those bonds. And that's really how they fund the government, is through these bonds and how they fund different programs on these open bond markets. So to see kind of weaker demand for that definitely hurt um, the bond market, which also can help the mortgage-backed security market because money moves into that. So it's kind of different bonds that you can buy, whether it's mortgage-backed or treasury bills, that type of thing. When there's a little less demand over there, sometimes the money will move into mortgage-backed securities. So I think that's what you're seeing a little bit today, is more of the money's moving there. The rates are a little more attractive on that. Also, the higher oil prices, we hit about $80 a barrel last week, which you're going to see going into the spring months, going into the summer months. People drive around a little bit more, and there's more demand. Products and goods get moved around a little bit more. But actually, I think I did see that lower down as of right now. Let's see, where's the calendar? I think last time I saw we're back down to about 78. No, 74. We're actually, crude oil is at 74.04. So that's actually a pretty good drop today. It's $2.95 from where it was to close on Friday. So that's good. Let's look at a couple other things on here. So the global manufacturing index for May came out slightly better than what they thought. The index was right at 50 and went to 51.3, but the ISM, the US manufacturing, actually dropped. The index dropped from 49.2 to 48.7. So that is a little lower than even their estimates. They thought it'd be a little better than that. The one that dropped probably the most is new orders. They came in at about a 4% drop, from 49.1 to 45.4. So this is always stuff that's a little bit more down the road. And I think that's why you're starting to see the Feds not wanting to do anything with interest rates right now, but they're kind of pushing that can back a little farther to let some of these numbers hit. Now, what you also start seeing for manufacturing, if it does weaken enough, you're going to see unemployment numbers go up. I think last time the unemployment rate was 3.9. Yep. And they're anticipating that should be the same on Thursday. That comes out on Thursday. Unemployment rate should stay somewhere around there. So if that ever moves dramatically, if you ever see the unemployment rate really take a move one way or the other, that's where you see a little bit of a run on the bond market, especially the MBS. So we'll see how that happens. ADP is coming out with their job creation. They're showing that it's expected to be about 173,000 jobs. And then Friday, the BLS is expected around 190,000 job creations, but unemployment's still about that 3.9%, which I think is really interesting to see. A lot of times what you'll see when they start to try to correct inflation, by raising interest rates, usually unemployment numbers spike, and that really hasn't. So this has been kind of a soft landing in ways. I mean, it's hard to talk about inflation as anything but hard. It's just a hard thing on our jobs and on our expenditures and just the day-to-day expenses of everybody. But you saw it spike up like crazy. You just see it's a little sticky to come down, but it has been trending in the right direction. You don't want to have it completely reverse the other way either. It's got to be kind of steadier moves is much better than anything that spikes up or down. But just been more sticky than we thought. But it also hasn't had some of the negative that usually comes with that kind of aggressive action to get rid of the inflation. So they use the term like soft landing or correction instead of crash. And I think that's what you're seeing. It's just a little stickier than they thought it would be. Then you throw in the election year. We've talked about that on this podcast many times. That it just isn't letting them lower the interest rates just yet. But there isn't talk about raising them, which is good. I haven't seen anything where the Fed's saying they're going to raise them, but there isn't as much talk about lowering them. There's a lot of talk May and June that rates were going to be lower, and they've just kind of flatlined. They've just been flat for quite a while. But I think it's better than having just spike all over the place. So it's kind of the new normal, somewhere in that 7% range for a 30-year fixed. Let me check Mortgage News Daily. They post their the average actual interest rates that people are getting. And as of today, we're 7.11%, slightly down from Friday. but with mortgage-backed security down about 21 or up about 21 basis points. So up is good for mortgage-backed securities as far as interest rates. Negative number, that means rates are going up. So a positive number is actually good for mortgage rates. So I should see the market open tomorrow with a little better rate, kind of continuing this trend. Let me look at the calendar here real quick, see if there's anything else for this week. So that basically gives us 3 straight days of improvement, but we're basically back to where we were on about May 15th or so, is where the mortgage-backed security market's back. So we kind of lost a bunch of ground from about May 15th to about the 30th, right before Memorial Day, and then we just kind of been getting it back a little bit. And you always see that going into a 3-day weekend. They're going to hedge their bets a little bit when the market's closed. It usually closes early on the Friday before. It's closed Monday. It can't react to anything that happens in the world stage, and so you usually see a little hedging going into a 3-day weekend. So most of that got burned up kind of today and towards the end of last week. So I would say it's a good day to float interest rates. I wouldn't lock anything if I've got clients who are looking to lock a loan. I'd give a little time and see if we can ride this trend. And then Thursday is probably the one we want to see. If we really see a spike in unemployment or these manufacturing numbers get dramatically worse, we might see a spike on that. But I think everything's heading in the right direction when it comes to that. Maybe we'll see the Feds do something with interest rates toward the end of the year. But honestly, I think it's going to push it into the first quarter of next year, which is what I've been saying for a long time. Everybody kept saying rates are going to get better in 2024. I don't see that. I don't think there's enough, because every time we get one good report, there's kind of one bad. It's just kind of a yin and yang, really this kind of motion, good, bad, bad, good, bad, bad kind of thing. But the manufacturing is something to look for, especially new orders. If they're slowing, that means that there'll be kind of that slowdown of products, which means that some of the money that is out there is going to get absorbed with what's available. Let's see if there's anything else, but I appreciate thoughts, feedbacks, comments, all that kind of stuff on these. Click and subscribe. I try to put out a bunch of content. Keeps me on my toes, kind of learning how all this stuff works, and I really do enjoy it. So if you have any comments, questions, please post them below, and we'll see you on the next report.